Well, forever, it seems like the only path to building wealth was paved with property deeds, right? But what if that whole idea is kind of wrong? Today, we are going to pull back the curtain on what it really costs to own a home, and we're going to rethink one of the biggest financial decisions you'll ever make.
There it is. The picture that's basically burned into all of our brains. The white picket fence. The symbol that you've made it. It's the whole American dream packaged up in one neat little image. But here's the thing. In the economy we live in today, is that dream actually a financial nightmare in disguise?
You know, we've all heard this a million times. It's the golden rule of personal finance. Repeated so often it just feels like this undeniable truth. But what if? What if that so-called truth is actually built on a shaky foundation of myths?
Yeah, what if that's not the whole story at all? I mean, with home prices where they are, interest rates bouncing all over the place, the whole market is just wild. Is sticking to this old advice actually leading a new generation into a huge financial trap? Well, that's exactly what we're going to get into.
All right, so let's dive right in. We're going to start by taking a good, hard look at the very foundation of the you have to buy argument. It is time to seriously challenge these ideas that we've just accepted for decades.
Okay, here is the single most important thing to understand. If you're only comparing a rent check to a potential mortgage payment, you're making the biggest mistake you can. The real math involves all the money you don't see. It's about hidden fees and something called opportunity cost, which is just a way of asking, what could your money be doing for you if it wasn't all tied up in one single illiquid asset?
So let's talk about the first major hidden cost. And believe me, this is the one that almost everyone underestimates.
It's called the 5% rule, and honestly, this is a total game changer. The rule is pretty simple. You should expect to spend about 5% of your home's total value every single year just keeping it from falling apart. And we are not talking about fun renovations here. This is the leaky faucet, the broken water heater. It's the slow, silent drain on your wealth that most homeowners just never see coming.
And this is where the math gets kind of staggering. For a pretty average $400,000 home, you're looking at $20,000 a year. That's 20 grand in costs that have absolutely nothing to do with your mortgage.
Just let that sink in for a second. Broken down monthly, that's an extra $1,600 you need to find. It's an expense that renters, well, they simply never have to worry about. It's like this financial black hole that can swallow your equity before you even have a chance to build it.
But it's not just about the costs. There's another massive advantage to renting that often gets completely ignored: financial agility, the power to pivot, to seize opportunities, and to stay nimble in a market that's always changing.
And you can really see the contrast here. A homeowner's wealth is basically shackled to their property. It's illiquid. You can't just sell off your living room to fund a new business venture, right? But a renter, well, a renter's capital is mobile. It's ready to be deployed at a moment's notice to wherever the best opportunity might be. And speaking of that illiquidity, trying to get your money out of a house is a financial battlefield. Between the ambush of closing costs and the big slice taken by commissions, you can lose a massive chunk of your home's value just in fees. Think about it. On a $300,000 home, you could be down $33,000 before you've made a single dollar in appreciation. Your home's value has to climb over that enormous hurdle before you actually start building any real wealth. It's like starting a race 100 yards behind the starting line.
This brings us to a really critical distinction. If you do buy, you need to be crystal clear about where the real investment value is, and it's probably not where you think it is.
Okay, think of it like this. The house, the physical building, is like a car. It's a depreciating asset. It gets old, it wears down, things break. The land it sits on, though, that's the actual investment. The land is what appreciates because, well, they're not making any more of it. Your house is the car. The land is where the money is.
Exactly. So you're not really investing in four walls and a roof. You are investing in a zip code. Your financial success as a homeowner depends almost entirely on your ability to predict the future of that one specific community. It's a high-stakes gamble on a single spot on the map.
So with all these hidden costs and market dynamics in mind, how should you actually approach this decision? It's time for a whole new framework for the rent versus buy debate.
And here it is. This is the real question. It's not which monthly payment is lower, it's what are you going to do with the difference? It all comes down to the power of the money you save by renting and what you can turn that into.
This is the renter's path to building wealth. Now, it takes discipline for sure,
But here's the strategy. You take the money that would have been a down payment, plus all the money you save each month, and you consistently invest it in a diversified portfolio. Historically, that approach can often outperform the total return of owning a house. So you see, it's not throwing money away. It's strategically putting your capital to work for you.
So this is the final question, the one you have to ask yourself. Are you buying a home because it's genuinely the best path for your financial goals? Or are you just doing it because it's what you've been told your whole life you're supposed to do? The answer might just change everything.